So here we are in class 15. So today we'll get into two closely related topics, measuring return, measuring risk. On the returns, we'll figure out how to calculate what's called a holding period return, which is just one period. And then we'll link that together so we can look at averages, whether it's an arithmetic average or a geometric average, two different ways of measuring averages for returns. And then see if we can somehow relate that to risk. We'll look at some terms that you've hopefully seen before: standard deviation, correlation. We talked about R squared earlier in the class, and in beta you should have had that in a previous class, but I'll show it to you somewhat different, in a somewhat different way than what you've seen before, unless you've had me for 3013. So let's go to page 32 of the class notes and let's talk about return. So our return is how your portfolio is done. So you're used to returns. So we like to take returns and break them into periods of time. So you could look at your return over a year. Well, that's a little long to wait. We could do it every day or even every minute. That's getting a little too picky. Although I was in a job where I got a report every single day that showed how all of my portfolios were doing. It was a little bit overkill. Did nothing but add a lot of stress to my life, because some days I was ranked high, some days ranked low, and it was just a little extra stress. So most people like to look at returns on a monthly basis. That's a pretty common approach. And then once we have those monthly returns, we'll then link them. That term link is very, very important. We'll link them so we can get some statistics over time, get average returns, get the standard deviation of returns, calculate betas, calculate correlations. But before we can do this analysis over time, we have to get the individual return numbers for each month or each week or each day or however it's calculated. When we did real estate before and private equity before, when we were talking about the different asset classes, generally real estate and private equity, you only get returns once a quarter, every 3 months. Stocks and bonds, you can get numbers every day, but if you're looking at a portfolio, most people report official numbers on a monthly basis. So those monthly returns, we'll call that each month. Each month has a holding period return. So each month will have its own particular holding period return. We are going to use this formula right here, a very simple formula. We'll take the ending market value of our portfolio or of our security or however we're doing it, minus the beginning market value. So that makes sense. The market value at the end of the month and the market value not at the beginning of the month, but the market value at the end of the previous month. Make sure you have that in your notes. So if we're looking at July, we don't want to look at July 31st versus July 1st. We want to look at July 31st versus June 30th. The last day of July, the last day of June, that's going to be our change in market value. So our beginning market value is actually the ending market value from the previous month. We'll then add what we call accrued income. We'll talk about accrued income. We're mainly going to talk about that with stocks. We're not going to get into bonds. Hopefully you will have an accounting class that will show you how to do the accrued income for bonds. It's a little messy and a little tricky, but we're not going to mess with that in this class. It's just a little bit too many calculations that we don't want to spend time on them. Hopefully you'll see that in another class. But it's fairly straightforward with bonds. If a bond pays a coupon every 6 months, which is pretty standard, then you don't want to wait until 6 months when they pay the income and bring it all in a 6 months. You want to essentially take 1/6 of that coupon and divide it between the 6 months. Now, it's not quite that simple. In accounting, they actually do a linked approach to that. That's a little more complicated, but it's essentially that. The key for us is we're going to focus on the accrued income for stocks. And we'll get into that here real quickly. And then you divide that by the beginning market value. So the beginning market value is both in the numerator and in the denominator. And that's a very simple approach to calculating return. Ignores the timing of your cash flows. So this is a very difficult formula to use if you bought a lot of the security. So let's say you started with $1 million and you ended with $3 million, but that's because you bought $1.9 million worth of securities. So you go from 1 million to 3 million. Part of it because the market value went up 100,000, but part of it is because you bought another 1.9 million. Well, this formula will not work in that situation. It only works if there have not been any purchase or sales of the asset during that period of time. I'll come down to this last bullet down here. A more sophisticated approach that you can look up, I actually recommend that you go out and do modified deets with Wikipedia. Wikipedia actually does a very good job of showing modified deets. Modified deets is the official way firms do it, and what modified deets does is it adjusts for the timing of these cash flows, purchases and sales, and does it in a way that the portfolio manager does not get penalized because the person that their client makes a bad decision on when to give them more money. Maybe they send on $1 million right at the top of the market, and that's not the portfolio manager's fault. And so the modified deets adjust for those cash flows so they do not affect the overall return. Now, we can debate whether that's the right way to do it or not. If you read my blog on the industry, you'll see that I actually think there's some problems with that, but that's the way modified deets works. The Chartered Financial Analyst Society, the CFA Institute, they recommend or they require the modified deets approach for calculating returns. At UTSA, we use the modified deets. If you've been involved in the investment society, in our student portfolio, we use modified deets there. So if you can ever catch me in the Bloomberg lab, I'll show you how we actually use modified deets to calculate our returns. If you use modified deets, you'll get a return very similar to what the Bloomberg machine shows for a security. And it doesn't matter if you had cash flows or not, because the modified deets takes the cash flow effect out. So even if you had cash flows, the modified deets will give you the same return as shown in the Bloomberg screen. So if you want to get more detail on that, it's complicated, and there's actually a lot of rules behind this. I had a department at UTSA that reported to me. Actually, they were looking for a place to report. They were somewhat in limbo. They didn't have an actual location, so they asked if they could come over and work in my department. And I took them on, and their job was calculating returns for all of UTSA's portfolios. I thought it was fairly straightforward until I got that department and discovered it's actually quite complex. There are some special things you have to do to make it work correctly. But we use modified deets. It is a more sophisticated formula. You'll notice it looks similar to this formula, but it gets a little more complicated because they have to put the timing of investment cash flows into it. So there's some weighted, how many days was it between the purchase? Was it halfway through the month, a third of the way through the month? All right, so that's just something you can do your own research on. I'm not going to actually quiz you on that, but it's a good thing to know. But let's talk this issue of accrued income when we're talking about stocks. We're only going to do holding period returns for stocks. We're not going to do them for bonds. I'm hoping you'll see that in your accounting class. But for stocks, what is the accrued income for stocks? And for stocks, stocks pay dividends. And the stock price, what happens to the stock price is when a firm pays a dividend, the stock price will not pay, I take that back. When this dividend comes out, and we'll talk about this idea of ex-dividend, on ex-dividend date, the stock price will actually fall by the amount of the dividend. That's on X date. But when the stock actually pays the dividend, that has no impact on the stock price whatsoever. It doesn't impact you at all. So why is that important? Well, there's 3 dates. There's the declare date, when they declare they're going to do a dividend. Nothing happens at all on that day, on that date. There's the ex-dividend date. The ex-dividend date's the most important. I'm going to skip it and come back to it. The last date is the payment date, when the dividend's actually paid. That one has no impact on the stock or the stock price. So the ex-dividend date's the only one that has an impact on the stock price. The ex-dividend date is the date that if you own the stock on that date, you will get the dividend. You're guaranteed to get the dividend even if you sell the stock tomorrow. So let's say you get ex-dividend today. The stock pays a dividend in 3 weeks, but you sell the stock tomorrow. Even if you sell the stock tomorrow, you will still get that dividend in 3 weeks. So what happens if the stock goes ex-dividend, which means after it goes ex-dividend, the stock price falls by the amount of the dividend. That way, you sell the stock tomorrow and the stock price has fallen by the amount of dividend, so you're out the dividend, but in 3 weeks you'll get the dividend. You'll be just as well off. The person buying the stock, wow, they looks like they got a really good deal because they got the stock cheaper by the dividend amount, but in 3 weeks they will not get the dividend. Only the person who owned the stock on ex-dividend date. So this is real key in your notes. Ex-dividend date is when the income accrues. So ex-dividend date is in July, then you put the dividend in July. Even if they declared a dividend in June and they paid the dividend in August, it doesn't matter. It's the X date. That's all you have to worry about. You can ignore all the other dates. When it shows X date, that's the month you will put the accrued income in. All right. So what we want to do is work some examples. I'm going to go to Yahoo Finance and we're going to work an example. We're going to do 2 examples. One is going to be Walmart. We're going to calculate holding period returns for Walmart. And then I'm going to show you how to link those returns using the arithmetic and geometric returns. All right, so here is Walmart stock. The ticker is WMT. They're currently trading for $142.29, but we want to calculate their return. And let's calculate their return for August, for July, and for June. So you want to get a piece of paper out and write these amounts down. So to do June's return, we need the price at the end of May. That's not going to be May 31st because that was a Sunday, but May 29th. We want the closing price. That's that second to last column. When we talk about beta, we'll talk about the adjusted close. But for our purpose, we want the close price. In fact, the difference between the close and the adjusted close are the impact of those dividends. So the close is what we want because we're going to calculate the return. So we want that column, the second from the last column. So if I go down, I want May 29th. On May 29th, you will see that Walmart's price on May 29th was $124.06. So that's the ending price for June's return, right? So when you're doing June's return, you want the last price from May. And then for June, we need the last price for June. So the June 30th was 119.78. So you can see their stock price actually dropped quite a bit, dropped from $124 down to $119.78, probably because of COVID-19, even though Walmart did very, very well. Now that June 30th will be the ending market value for June and the beginning market value for July. So let's go to the end of July. July 31st, you can see really good recovery for Walmart. They jumped from $119 to 129. So the whole stock market was coming back, but Walmart did very well. So that 129.40 is the ending market value for July and the beginning market value for August. Then we'll do August. We come into August. What you'll notice is August 13. So let's write that down. August 13, there's a dividend of 54 cents. So the question is, what is Yahoo Finance showing us on August 13? Is this the dividend declaration date, the ex-dividend date, or the dividend payment date? You might think it's the dividend payment date, but it is not. What Yahoo Finance is showing you is the X date. It's the date we want. So this dividend went X on August 13. They may not pay it until September. They may have declared it in July, but we don't care about that. All we care about is what is the X date. The X date is August 13th. So we need that income, that accrued income. And in August 31st, again, their stock price did great, up almost another $10, 138.85. So I'm going to switch over to Excel, and we will calculate their returns using these numbers. So let me type in what we've got here. We've got May 29th, which is really May 31st. We have June 30th. We have July 31st. And we have August 31st. And then ex-dividend date is August 13th. and that is 54 cents. And then the prices, if you remember, are 124.06, 119.78, 129.4, and 138.85. I'm going to change those to be dollars and cents. Change my dividend to be dollar and cents. So let's do the holding period. Remember that the holding period return equals ending market value minus beginning market value plus accrued income, all of that divided by beginning market value. So let's do that for June. We can't do it for May, right? Because for May we don't have the beginning market value. So let's do for June. So for June, I'll do it without actually calculating. I'll just show you the formula. So we have 119.78 minus 124.06. And since the dividend went X in August, our accrued income is 0. We don't have any. We divide that by 124.06. So do that math and see if you get this answer. You might freeze the videos so you get your answer before I show my answer, but I'm going to hit enter and you'll see my answer. There's my answer. I'm going to give it 2 decimal places. So Walmart stock return was negative 3.45%, but the whole stock market was down a bunch. So it maybe not just be Walmart. Now let's do July. So July, the ending market value is 129.40 minus beginning market value 119.78. Again, no accrued income, only in August, divided by beginning market value 119.78. So calculate that and see if you get the same answer I get. I got a really strong return there, 8.03%. Somewhat probably similar to what the overall market's doing, although I think Walmart did really well, even compared to the great return coming out of the downside there. Now we'll do August. So August we have a little bit more work here. Our ending market value is 138.85. Beginning market value is 129.40. But here we have accrued income, 54 cents. So add 0.54 and we divide all of that by 129.4. So try that and see if you get the same answer I get. And I get 7.72%. All right, so those are our holding period returns for Walmart. What we'll do is we'll learn how to actually link those together here in a second. But we got our holding period returns. I want to do one more holding period return. I want to show you a special case, but hopefully you've got those answers. You practice. Make sure you're getting parentheses in the right places. Use the parentheses on your calculator so that you make sure you get everything in the right place. But there's our returns for those 3 months, a loss in the first month and a gain the next 2 months. So I'm going to go back to the internet and I'm going to, instead of doing Walmart, I'm going to do Choice Hotel. And what I want to do with Choice Hotels is I want to go back to the historical data, which is where I am. But I'm going to go back to a particular point in time. I'm going to go back to 07/31/2012 through 10/31/2012. Hit apply, and you'll see why I want to look at this particular point in time. So let's go back and do the returns again. Get a piece of paper and write down these numbers so that when we go into Excel, you'll see where I got them. So we want to do August, September, and October, but we need July as our beginning market value. So the last number in July was 40.08. You'll notice a huge difference between the actual closing price and the adjusted closing price. You're going to see why that's the case here pretty soon. All right, let's go through August. What do you notice on August 24th? August 24th is an X date, and it's a huge dividend. Huge dividend, $10.41. look at the closing price. It went from $43 to $31. We actually own Choice Hotel in our portfolio, and I remember seeing that and going, oh my word, what happened? Did they get really bad news? I had no idea they had a special one-time dividend. So it looks horrible, but if you look at the adjusted close, the stock price did not fall all that much. Only fell, well, it fell $1. That's still a big drop, but not nearly as much, not 25% that it shows here. And that's the difference between the adjusted close and the close. Because they went ex-dividend, their stock price fell by that dividend. Now, why in the world did they do this huge dividend? Well, at the time, Choice Hotels management was worried about Congress. There was a sense that Congress was going to do a huge tax change in 2013 that was going to cause dividends and capital gains and all kinds of things, the tax rate go up dramatically. And so what they decided to do, and a few other firms worked on this, even some of the mutual funds I worked with at UTSA even thought about this. Should we do a special dividend to take all these gains that we've had, all this income that we've had, let's do it so that they pay the tax this year instead of next year because Congress might change the tax code. Now you got to be careful of doing that because Congress in fact did not change the tax code. And because Choice Hotel did this, they caused their stockholders to have a huge tax liability in 2012. But that was the rationale. They did a special one-time dividend in August. So then we'll get the August 31st price. August 31st price is $31.51, almost $9 lower than the previous month. But it's really not that big of a problem because of that special dividend that they paid. Then we'll get September. We'll look in September. On September 28th, they had another dividend of 18.5 cents. Wow, they're sending a lot of money to their stockholders. So there's September. The last price on September is $31.99. And then we go to October 31st. No dividends in October. There is no October 31st. I'm not sure why. Let's see if we can get... Let's put 11:30 in there just to make sure. That doesn't make sense to me that we wouldn't have something later in October. Let's see what we have. Oh, there is an October 31st, and that is 31.29. So there's our four prices and our dividends. Let's go back to Excel. And here we're going to do a little bit different here. We're going to do July 31st, 2012. And then we'll do August 31st, 2012. And then September 30th, 2012. And then October 31st, 2012. And our prices were 40.08, 31.51, $31.99, and 31.29. Let's make those all dollars and cents. And then we have some special dividends. The ex-dividends that we have one on August 24th, 2012. That was a special dividend. And we had another one on September 28th, 2012. So the special dividend was $10.41. And the regular dividend was $18.50, 18.5. So let's do our holding period returns. So we can't do July, but we'll do August. So that's going to be, August will be 31.51 minus 40.08. But we have income. Remember, ex-dividend, August. So we add the 1041, and we divide that by the 40.08. Try that on your own, see if you get the same answer I get. And look at that. Their stock price was actually up almost 4.6%. Even though the stock price fell over $8, their stock price fell over $8, their still stock price is up. If we did not put that accrued income in there, if we had left it out, we would have showed a 21% drop in the price. But because of that dividend, they were actually up 4.59%. That's why it's so important. Now, the nice thing about the adjusted close that we didn't use, if you use the adjusted close, it will give you the 4.959%. So essentially, adjusting close is giving you the return by incorporating the dividend as if they took the dividend and bought more shares, and that was in your ending market value. So the adjusted close is actually a really valuable number that we'll use when we do beta, and you'll see why. All right, so let's now go to September. Well, in September, we got $31.99 as the ending market value minus $31.51. Plus, well, September, we have income too, 18.5 cents, right? They went X on September 28th. We divide that by the beginning market value, 31.51. So check that out and see if you get the same answer I get. So still up. Good month there to 11. And then the last month, we got 31.29 minus 31.99. There's no accrued income. We divide that by 31.99. So they finally had a loss. Pretty volatile stock the last few months there. And there's a lot going on with Congress, and so that might be part of it. Plus, it's a hotel chain, which is a high, a very cyclical business. So you can see how important it is to get those dividends into this. Now, if you're doing modified DEETs, you would actually adjust these dividends for the actual date. So you didn't get this dividend until the 24th, and they would actually, in modified DEETs, would adjust the fact that that $10.41 didn't happen until closer to the end of the month instead of beginning of the month. But for our purposes, we're doing a simplified formula. We're just going to show the number for just without any adjustment for the time lag. All right, so let's go back to PowerPoint. All right, so there is the holding period return. So let's jump to pages 32 and 33 in the class notes. And let's talk about how to link, that term link. It's really important. Let's link these returns so that we can talk about how the stock has done over time. So right now we just have three numbers. Can we link that in a way to get an average? And there's two ways to get the average. The easy way is the arithmetic average. There, if we're looking at 3 months, we just add up the 3 months and divide by 3, and it gives us the average for those 3 months. The geometric's a little more complex. We'll actually geometrically link them by taking 1 plus the return of each period and taking that number and multiplying it by 1 plus the return for each other period. So there's the two approaches, the arithmetic and the geometric. One thing to know right now is the geometric average will always be lower than the arithmetic, lower or equal to the arithmetic. So the geometric is almost always lower. Occasionally it can be equal to the arithmetic average. So be aware of that on the exam. If you get a higher number for the geometric average than the arithmetic average, you did something wrong in the math. It's mathematically impossible to get a higher geometric average. The other thing we want to do is we want to annualize these returns. You annualize arithmetic averages by just multiplying by how many periods there are in a year. So if you're doing monthly returns, to annualize it, you take the arithmetic average and multiply by 12. If you're using weekly numbers, you take the holding period for weekly, you take the average of those weekly returns and multiply by 52. For the geometric, instead of raising it to the 1 over n, you instead raise it to the 12 over n for monthly, or 52 over n for weekly, and then subtract 1. So we'll work on these two formulas. Be careful when you annualize geometric averages. An annualized geometric average can be higher than an annualized arithmetic average. The geometric average cannot be higher, but the annualized geometric average can be higher. According to the CFA, and I want you to put this on the exam, I'll give you 3 months, and maybe if everybody's using Excel, I may give you more months, we'll see. But according to the CFA, you can't annualize holding period averages if it's less than 1 year. We are going to do that in our exercise. I'm going to take a 3-month holding periods, I'll take the averages and I'll annualize it. We can't do that officially because it's only 3 months. We can't annualize 3 months. If you had 20 months, you can annualize that. If you had 13 months or 15 months. But so what I want you to do on an exam is you'll annualize the return, and if I only give you 3 months, you need to put an asterisk and say the CFA does not allow you to annualize a period of time that's less than 1 year. All right, so let's go back to Excel. And let's try that. So let's start with Walmart. Up here we have Walmart. So let's do the Arithmetic Average. So the way we can do that is we can just take the returns and make sure you convert everything into decimals, not percents. It's a lot easier that way. Minus 0.034 plus 0.0803 plus 0.0772, and you just divide that by 3. That's all the arithmetic average is. And when you do that, I get 4.1%. I'm going to move this formula up here. So there's our arithmetic, I think it's metic, not matic, arithmetic average. Forgive my spelling, I always get geometric and arithmetic. Geometric has an R at the end, arithmetic does not. So let's check this with Excel. So in Excel, you just type equal average, and you go up and do that. We might be slightly off because of rounding, but it should be pretty close. But no, it's the same, 4.10. So that's good. There's the arithmetic average. Now let's do the annualized arithmetic average. So how do you do that? Well, all you've got to do is take 0.041, the monthly average times 12. That's all you have to do. Very simple formula. I'm going to actually reference it. And there you get 49.20. You might be slightly off. No, it's the same. So it's rounding could be an issue because I'm doing this. So yeah, you take 4.1%, the arithmetic average, times 12, because this is monthly. Again, if we were doing weekly, we multiply by 52. So there's your arithmetic and average and annualized arithmetic average. All right, so now what we want to do is let's shrink these down a little bit. And let's work on the geometric averages. So the geometric average so here's the formula. It's a little bit more complicated, but what we're going to do, 2 parentheses, 1 plus that first period, so it's actually minus 0.0345, close 1 parentheses, not both, times 1 plus the next period, 0.0803, close parentheses, times 1 plus that last period, 0.772. Close parentheses, so you have all of that. Then you're going to raise that to 1 divided by n. Well, what is n? Well, we have 3 periods of time. So you divide it, you raise it to the 1/3 power, and then you subtract 1. You can go back and look at that formula. This is a very, very important formula. If you've never used this formula before in your college career, boy, you really need to start using it. It's a very, very popular formula. And when we do that, remember we said the geometric average must be less than the arithmetic average. The arithmetic average is 4.1%. And you can see, sure enough, we got something that's less than 4.1%. It's 3.96%. All right, so there's the geometric average. And then we're going to annualize the geometric average. And it's, again, we can just take this formula we've already done. It's the exact same formula. And all we do is, instead of raising it to the 1/3, if it's monthly, we raise it to 12/3. If it's weekly, it's 52/3. So all you got to do is make that one change. And so we can just copy this over, and we just change this to the 12 over 3. Now you notice the annualized geometric average can be higher and often is higher than the arithmetic average. But the annualized arithmetic average. So the arithmetic average can be lower when it's annualized. The annualized number, that can be higher or lower for geometric, but annualized geometric average. But for the actual averages, unannualized, the geometric must be lower. All right, let's practice this again. Let's come down to Choice Hotel. And let's do the arith average and the annualized arithmetic average. Let's do the geometric average, and the annualized geometric average. Let's do them all. You practice it yourself. You might pause the video and see if you can do it yourself. I'll do it typed out so you can see it. And so I take those 3 numbers and divide by 3. And I get 1.5%. And then I'm going to check it using Excel just to make sure. And sure enough, I get 1.5%. To do the arithmetic average, all I got to do is take 0.015 times 12. Just annualize it, so I just take that times 12, and that gives me 18.04%. The geometric average, again, a complicated formula, O parentheses, 1 plus 0.0459 times 1 plus 0.0211 times 1 minus 0.0219, close parentheses, raise it to its 3 months, so 1 divided by 3. If you're doing 50 months, then it's 1 divided by 50. If it's 100 months, it's 1 divided by 100. All right, so the denominator of what you're raising this to is always how many periods do you have here. If it's 3, it's 3. If it's 100, it's 100, whatever that is. Close parentheses and then minus 1. Oops. So it must be lower than 1.5%. And so when we do the math, sure enough, it's slightly lower than 1.5%. And then the geometric average, it's the exact same thing again, except for we're still going to divide by 3, but we're going to take it to the 12 over 3. So we can just copy that formula over and do 12 over 3. So 19%. You notice here the annualized number is higher. So for both of these, what we want to do is put an asterisk on the annualized average, just on the annualized. And we want to put the footnote on both of these. On the annualized numbers, there's got to be a footnote. And our footnote will say, CFA Institute does not allow for annualizing averages for periods less than 1 year. So we've got to put that footnote in there. So those two annualized. It doesn't affect the arithmetic average and geometric average. That's fine. We can report that. We just can't report the annualized numbers if it's less than a year. Now, if it's 13 months, 20 months, whatever, we can annualize those. All right, so what I want to do is go back to the internet, and I want to bring in, wow, Apple's been doing so incredibly well. Let's bring up Apple stock, and we'll bring in its historical data. But what I want to do is I want to bring in monthly data and hit apply. And I want to go back as far in time as we can go. So I'm going to do the max. And the end date, I'm going to put 8/31/2020. And apply. So I have Apple for the longest period I can get. I'm going to get I'm going to again hit this thing and click max. For some reason when I hit max, it didn't do it. So back to 1980. So on a monthly basis, so I've got monthly data here, and I'm now going to download that. And I want to show you some data. We can do a lot of things with this. So we'll keep this file even for the next class when we talk about standard deviation and beta and those other things, because we'll have quite a bit of use for it. So, and what we're going to do is we have the open, the high, the low, and the close, but we actually want the adjusted close. Remember, the adjusted close adjusts for those dividends and gives us much better data because we don't want those dividends distorting our numbers. So we're going to get rid of everything except for the adjusted close. You notice I don't have the dividend information in here, but it really is in there because it's in the adjusted close. So it's there. I'm going to adjust this to dollars and cents, and then I'm going to add a row. So if you want to try to copy this, I brought Apple's stock price in, the adjusted close on a monthly basis as far back as I could go. So I'm from 1980 through 2020, or through August of 2020. And now I'm going to do a monthly holding period return. Remember, the holding period, we can't do it for the first month because we don't have a beginning value. The holding period return is just going to be the ending value ending market value minus beginning market value plus accrued income divided by beginning market value. But in this case, the accrued income is already part of the adjusted close. It's already in there, so we don't have to do the accrued income. So we essentially all we need is the ending market value minus the beginning market value. We can say plus 0, but I'm going to leave it out, divided by the beginning market value. And that gives us our return for that first month, which is really low, negative 17.22%. And then over here, there's a little green box there. If we double click that, it will copy that down all the way down. So if you notice what I did, let's do it again. I calculated the holding period return as ending value minus beginning value divided by beginning market value. I went up here and I clicked on the percent sign. So I get it as percents. I gave it 2 decimal places. I then clicked on this little green box here, so we copy it down. So there's my holding period return. So I'm now going to do Control and hit the down arrow, and I have all of these. So let's do the monthly arithmetic average. And remember, that's really simple. You just do equal average. I'm going to do Control, Shift, hold your Control and Shift keys down and hit your up arrow. And then close your parentheses. There is the monthly average for for Apple stock. That may not sound very high, but that's a monthly average. Let's annualize the arithmetic average. And here we can do that, right? We don't need a footnote here about the CFA because in fact it's more than 12 months. It's more than a year. So all we got to do is do the monthly average times 12. And that arithmetic average is 28%. That's really good. The next thing we wanted to do is the geometric. And I don't know how to do that in Excel other than do it by hand. I keep thinking Excel will add that, and I just don't see that formula yet. If one of y'all find that formula, let me know. I should have tried again before this class just to see, but we have to do it by hand, which is not a bad way to do it. So to do it by hand, so there's that. So we're going to geometrically link these returns. How do you do that? Well, you start with the very first one plus that very first month. What we're saying is if we had $1 to start with, we invested in their stock, at the end of the first month, we would have only 83 cents left. The next month, we're going to take that previous month times, open parentheses, 1 plus the next month. So what we're saying is if we had started with $1 on 12/1 at the end of December, these are say 12/1 and 1/1, but they're actually 12/31. If we had started with $1 here and we invested in Apple stock, at the end of the second month, we'd only have 78 cents left. Our $1 would have dropped down to 78 cents. And we're geometrically linking them, so I'll put the formulas over on the side so you can see them. And now we can just copy, now they're all linked. We're just going to be linking them down, and now we can copy this second formula all the way down. By the third month, you would have lost 28 cents of your dollar, 28%. But then it starts roaring back, but then it falls again. In September of 81, you would have lost over half your money. In 82, you would have been down to, you would have lost almost 2/3 of your money. Then finally, in 93, you're back above $1. Now you're doing pretty well, but then you lose it again. So you can see how volatile it is. We had a pretty volatile stock market in the early 80s with 2 recessions. So it's just all over the place. But let's go to the very, very end, control down. At the very, very end, that $1 would be worth $1,071.67. If you put $1 into Apple in 1980, that $1 would be worth over $1,000 today. That's pretty incredible. All right, so to do the geometric average, we need to first know the number of periods, right? Because we need to raise it to the 1 divided by the number of periods. So let's go figure that out. We'll do an equal count A. We want the actual count. So we'll go up and we'll do Control Shift up and we'll count just the returns. And we see it's 476 months. And so the geometric average will then be that last linked number raised to the 1 divided by 476 minus 1. Remember, it must be lower than 235. And so when we do that, you see it's quite a bit lower than 235. I'll put this formula over on the side. This formula over on the side. So there's our geometric average. Now let's annualize. And the geometric average is much closer to your true return than the arithmetic. So, you know, in your stats class, you might have talked about this. If you're trying to tell someone how they actually did on an annual return basis, the geometric average is the better number to tell them how they actually done. If you're going to build a model where you're going to run models and do efficient frontiers, you want to use the arithmetic average. And I'll show you why here in a second, why you want to do that. So the annualized average, remember it's the exact same formula for the geometric average, but when you annualize it, instead of doing 1 over 476, we do 12 because this is monthly data. If we brought in weekly data, we would have done 52. And so there, that gives us our annualized average. Here, the geometric annualized is actually lower than the arithmetic. It can vary, it just depends. And now, why is this 148 lower than the 235? And the formula I gave you in the class notes says if these returns are normally distributed, and we don't know that with Apple. In fact, this formula helps us determine if they're normally distributed. If they are, then the geometric average should equal the arithmetic average minus 1/2 of the square of the standard deviation. So I'm going to calculate the standard deviation. We'll come back to standard deviation later, but I just want to show you this. So we can do a standard deviation equal STDEVP. We want to use the population standard deviation. Let's go to these returns. We can see the monthly standard deviation for their stock is really, really high. So let's test this. Let's check the geo average using this formula. So we'll put this formula down here. Let's see if I can shrink this down a little bit more. Put this formula down here. Let's check it. So we'll say the geometric average should equal the arithmetic average minus 0.5 times the standard deviation squared. And when I do that, I get 1.49. You see the actual geometric average is 1.48. 1.49, 1.48. But really, really close. So Apple stock must follow pretty close to a normal distribution. Must be pretty close to normal distribution, which means some of the stuff you learn in your statistics class on normal distributions you can actually use. So I've introduced you with the first risk number. We won't get into risk in detail this class, but at least I've introduced you to it, and we'll talk about it more. So what does that mean? Well, the arithmetic average will overstate your return. I'm talking about the monthly one, because of risk. And let me show you that in a very simple way here. Let's say your uncle comes to you with $100,000 and he says, invest it for me. And so you invest it, and in month 1 you make 50%. And in month 2 you lose 50%. All right, so how did your uncle do? Well, he started with $100,000. At the end of the first month, you took that $100,000 and you added 50%. So you multiply by 1 plus 50%. So at the end of that first month, you have $150,000. Then you go to the second month. The second month, you start with $150,000, but you lose 50%. So now you have $75,000. So what return did your uncle have? Well, let's look at the arithmetic. Sorry, I don't know why I can't spell arithmetic. The arithmetic average is just going to be equal average of those two, and that's 0%. Try explaining that to your uncle. He gave you $100,000. You invested it for 2 months. Now he has $75,000. You say, oh, uncle, your return was 0%. He's going to look at you a little bit funny. You can say, what do you mean 50%? I didn't make 50%. So let's try this geometrically linked. So let's do the geometric average. Geometric average. So there we do 1 plus 0.5, close parentheses, times 1 minus 0.5, close parentheses, raised. We only have 2 months, so 1 divided by 2 minus 1. So there's our formula. When you do that, you get that your uncle lost, on average, 13% a month. That makes more sense to him. Let's actually even try that. So he starts with $100,000. In the first month, let's say he loses 13%, so we take $100,000 times 1 minus 0.134. And then the second month, he starts with $86,000, and he loses again, so 1 times minus 0.134. If we do that, we get really close, not quite $75,000. If we'd actually referenced the cell, instead of just using the rounded number, we would have gotten exactly the answer. So instead of using the rounded number, I'm going to actually reference it. Well, for some reason it's, oh, because I didn't, yeah, I'm not sure why. It should come out exactly the same, but it's not coming out exactly the same. But these two numbers should be pretty close to the same. So essentially what the geometric average is telling you, it's like an internal rate of return. It's the return that if you applied it to your beginning investment and multiplied by all your cash flows going forward, you get right at your ending balance. So your uncle's probably going to accept the fact that he lost 13% on average a month, much more than he's going to believe that he made 0%. If he ended up with $25,000 less in money than he started with, then that kind of makes sense. Now, we can calculate the standard deviation of this. it may not work so much here. So if we take the arithmetic average minus 0.5 times the standard deviation squared, we get 12.5. We don't get 13.4. But this is not really normally distributed. We only have 2 data points. So it kind of gives you in the ballpark, but not quite. But that's where we have arithmetic and geometric. Geometric really tells you what your true return is. And that's what you should be doing if you're reporting historical returns. And that's what firms do. When they report historical returns, they provide geometric average. However, if you're going to create a model where you want to simulate returns going forward, maybe you want to run 1,000 simulations, then you want to use the arithmetic average and apply it with the standard deviation. And if you do that, you run scenarios where you get the arithmetic average and you have that standard deviation. Then when you look at all of the runs of your scenarios, you will come out with geometric averages that look more like this. So it's a little complex. I had this debate at UTSA. They run a stochastic model, and they want to use geometric averages with the standard deviation for the arithmetic average, and that just doesn't make sense. You understate your return. So I had to convince them it makes more sense. So arithmetic average is what you're using anytime you're running some type of model, like an efficient frontier model, where you have returns and you have risk, you have standard deviation. You want to make sure you're applying arithmetic, because arithmetic averages go with standard deviations, and that's how you link them together. So anyway, there's what we have for Apple. What I want to do in future sessions is work with some of these risk numbers and apply them to a firm like Apple. We'll probably try a few other firms. But what I want you to be able to do is make sure you understand these formulas. Some of you may have forgotten the formula for standard deviation. If you did, you need to go back and learn it. An extremely important formula to understand, and I'll show you why in our next session, why that's so critically important. I want to show you how correlation works and R-squared works, so that you understand that. To do that, correlation, R-squared, and beta, I have to have another data series besides Apple. I have to have the S&P 500 or another stock. So we'll have to look at that. So I'll bring some data in and we'll work with this. But what I want you to be able to do is do the formulas as Excel shows them. STDEVP and the slope formula for beta, the correlation formula for correlation, the R-squared formula for R-squared. They're all in Excel, but the other thing I want you to be able to do, and I'll show you this in the next class, is be able to calculate those things manually in Excel so that you know the stage through each one. I want to show you how these formulas are so very, very similar. The other thing we'll do next class, though, and it's going to look very similar to what we did with Walmart and Choice Hotel, is I want to show you an actual problem from a previous exam and have you work that, so that you can get some practice. But I'll stop it here. I'm trying to stop these at about an hour because of our weekly Zoom that we're doing to catch up. But practice this. Maybe even try it with another stock. Try Google or try Walmart or try another stock. Exactly what I did here. And then I'll give you some practice problems next class, and we'll actually have, so you can submit some of them and see how close you get. So we'll stop it there.